Let me now bring on board Michael Kurtz, Chief Asian Equity Strategist at Nomura. He joins us from Hong Kong. Michael, how do you see Asian equities as an asset class? So far, so good, but does it? Do you think the springtime for Asian equities is over?
Yeah, Asian equities still look to us like a pretty good play on both the recovery and global demand growth underway, and I think really principally with the U.S. economy as a critical driver there, Asia giving you a lot of leverage on that pickup in U.S. demand through the export sector. But still with a fair amount of value to be found in the region, and at the same time, at least the potential backstop of Chinese demand growth as well.
So you don't see any signs of fatigue in this risk-on rally then?
I wouldn't quite say fatigue so much as a need for a healthy consolidation. Stocks have come a long way since the middle of 2012. They are a lot less deeply valued than they were back in the middle of last year. But we don't believe that the underlying driver here, which is a combination of a pickup in global demand and an ongoing flow from one asset class to another, primarily from fixed income into equities, neither of those two drivers have really exhausted themselves yet.
Michael, how do you explain the disconnect between rising valuations and when earnings momentum is slowing? Are markets already discounting a earnings trough though?
It certainly does look as if stock prices have already moved ahead of the earnings consensus numbers. So in that respect, we could surmise then that equities are assuming a certain amount of upgrade yet to come. And that does probably mean that going forward, upside for Asian stocks is going to really rest a lot more on the liquidity argument. We do need to see ongoing evidence of money coming out of those safe haven type assets, fixed income, money market funds, etc., and into the more growth sensitive or more inflation sensitive asset class that is equities. There is evidence that that rotation is well underway, and certainly no reason to believe that it is by any means near the end of its course yet. But we do need to see the liquidity, I think, in order to keep the Asian equity story moving.
So what makes you bullish in emerging Asia? Because your report talked about best emerging market combination of value and growth. Can you give us some more color on that?
Well, in Asia, we think you get effectively a sort of leverage on developed market growth. And so while the U.S. recovery really for us is the principal backbone of a global demand pickup over the next 12 or 18 months, the fact is that Asia historically gives you earnings leverage on that pickup in the U.S. In fact, over the past decade, for every 100% increase in U.S. earnings, we would expect to see about a 250% pickup in Asian earnings. So it's a more than 2-to-1 sort of leverage on the earnings recovery. Asia is still value in the sense that you're getting it at least small discounts to long-term average PE multiples or price-to-book multiples, although admittedly at this point we're talking about single-digit discounts, nothing like the double-digit or almost 20% discounts that you could get 12 months ago.
Michael, what about India? Do you find Indian markets are reasonably priced? And what kind of growth are you penciling down for Indian markets in 2013, which is the current calendar year?
India looks a bit challenged to us, in fact. The market overall is selling at just about 13.5 times forward earnings. And while that's no worse than about in line with long-term averages, it is a long-term average that was established during a period when India was growing considerably more strongly than it is today. So, for example, the 8.5% type GDP growth numbers that we saw in India not more than just 4 or 5 years ago are now down in the neighborhood of 5.5, which is basically what we're looking for in 2013. And from that perspective, you could argue that Indian equities are at this point still relatively aggressively valued, because in line with long-term averages that were established at a much higher growth rate than we're seeing today suggests that equities are not really yet fully sort of in touch with the slower growing reality of India today.
So, Michael, looking at the backdrop of risk appetite improving, how would you play equities, defensives or cyclicals? Is it time to add beta to one's portfolio?
There are still quite a bit of uncertainties out there in global markets today. A lot of questions about, for example, Chinese policy and the reform outlook under the new Xi Jinping, Li Keqiang administration. There are still some pretty substantial uncertainties emanating from Europe between Italian politics on one hand and the Cyprus bailout on the other hand. And even in the U.S., which we still think is pretty much a bright spot in the global opportunity set, there is still, for example, the unresolved part 2 of the fiscal cliff. So with all of these uncertainties out there, admittedly, investors may want to hold on to some relatively defensive positioning. And certainly within Asia, we think the telco sector gives you the best combination of relatively low cyclicality, low beta, but relatively high total returns because of the, in most cases, pretty robust dividend yield that you get from that sector. But otherwise, looking around Asia, we really do see some of the deepest value in the higher beta type sectors. I would point in particular to both the tech sector and the consumer discretionary sector as being deeply valued and still, quite a bit of leverage in terms of cyclicality. And then within the financial sector, maybe in particular banks and brokerages, we see interesting opportunities there, both from the standpoint of value and from the way that they would benefit from an ongoing steepening of the yield curve and improving global growth outlook.
Michael, so finally, what are you expecting from the Fed later this week? Do you see any kind of danger to the rotation rally if indeed the noise on Q3 exit becomes louder?
This is probably going to be a relatively inconsequential Fed meeting in the sense that we certainly don't expect any major changes to their forward guidance. I think that Chairman Bernanke probably felt a little stung by the market response to the January Fed minutes that were released about a month ago, 3 weeks ago, in so much as even a relatively sort of indecisive suggestion that the FOMC was not foursquare behind sort of keeping QE in place for as long as it is blueprinted for, was actually a major shocker to markets and tipped off quite a bit of volatility in the near term. With that experience still pretty fresh in his mind, we think that the Fed chairman is going to try pretty hard to maintain a message of continuity in monetary policy. And as such, we're likely to see very little more than perhaps a bit more elaboration on the issue of the costs versus the benefits of QE, but one that clearly resolves in favor of the benefits still being by far the more important consideration for the time being.
Michael, good chatting with you. Appreciate you taking the time out and joining us today on ET Now.